What I was going to talk about was what Trump means for your individual taxes and your business taxes. And by way of preface, just so you understand the context here, Trump put out a tax plan early in his campaign, and that was scored at about $10 trillion deficit. Then, after people got on his case, especially from the Republican House, he came up with Trump 2.0, and that's what I'm going to be talking about, which only has a deficit of $6 trillion. Now, you'll hear people in Washington all the time saying, oh, don't worry about it, $6 trillion, but it promotes economic growth, so the numbers all work out. Well, I'm here to tell you that that's ridiculous. That's what's sometimes called a static estimate. But these numbers come from the Tax Policy Center, Brookings and Urban Institute. I happen to be chairman of the board there, full disclosure. But they use a dynamic estimate. And the key is this. Yes, you will promote economic growth, but you will also increase the deficit, will increase borrowing costs. And when we're borrowing as much as we do as a country, that will make a huge difference. If you haven't noticed, in July, the 10-year Treasury was at, anyone know? What was the 10-year Treasury rate in July? Somebody quickly? 1.4%. Today it's 2.2%. We've had a 50% increase in the cost of borrowing since July. That's an incredible number. And it will have tremendous reverberations. And the reason why it comes into play is that Trump is proposing, I think, $1 trillion in infrastructure. Before me, people were talking about they need more infrastructure. Well, go to the White House. He's handing it out. $1 trillion here, $500 billion here. Everybody likes infrastructure. And I can assure you, no one has any idea what they mean by infrastructure. So if you have an idea that actually makes sense, you ought to go there because they might just adopt it. But if you spend $1 trillion in infrastructure and you spend even $4 trillion in tax cuts, you're going to have to raise the national debt level. And this is sort of a little Washington secret. They were having a lot of problems last year with the national debt ceiling. And it was $20 trillion, and so they decided to suspend it, meaning we don't worry about it till March, and then it automatically cuts in. The problem is, the day after it cuts in, we've exceeded it. So even though Treasury is very adept at playing games, by the summer we will have to have a vote on raising the debt ceiling. And that is the most important constraint, in my view, on Donald Trump. Because although Republicans will love tax cuts, they do not like to raise the debt ceiling. And he's got 60 to 70 Tea Party people who really will hate it if they have to raise the debt ceiling by 2 or 3 trillion. So he's got to balance that out. So when you go to Washington to pitch your infrastructure projects, try to make them all guarantees and everything that's off balance sheet. Nothing that has to actually go on the balance sheet. So those are the basic things we have to understand, and in the context of looking at his tax proposals. So I'm going to divide his tax proposals in 4: individual tax, estate tax, domestic corporate tax, and foreign corporate tax. And at the end of each one, I'll take a few questions because I really hate lecturing and I usually don't lecture at all. So on individual tax, Trump proposes that we take the current 7 rates and bring them down to 3, 12%, 25%, and 33%. So he's taking the top rate down from 39.6% to 33%. So that's actually not an outrageous proposal. We were at 35% not so long ago, and he very well might be able to get down to 35%. Another thing that we can count on is everyone who makes more than $250,000 pays a 3.8%, who has investment income more than $250,000 pays a 3.8% surcharge, which is geared to support Obamacare. That will definitely be taken away, and that will be a big deal. Now, Trump is going to help lower and middle income people in a number of ways. One is He is definitely committed to increase the credit for child and dependent care, and that was something that his daughter really wanted, so I think it really will happen. And obviously, it will have Democratic support. Second of all, there is a wide bipartisan consensus that we need to increase the earned income credit. That's a credit that people get who are low income, and as they make more money, it gets smaller. In fact, it gets so small that after a while it's not worth working. So therefore, they're going to rejigger that formula and encourage people to work, and that has bipartisan support. The other thing that Trump is going to do is he's going to consolidate the personal exemption with the standard deduction, and we're going to wind up with a standard deduction that's much higher, something like $30,000 for a joint account, and that will mean that lots of people will not itemize, which is a good thing if you've ever itemized. And his probably most radical proposal from the point of higher income people is he's proposing, at least he's talking about, a cap on itemized deductions. This is actually an idea that Marty Feldstein from Harvard has had for quite a while. The current version of it is a cap of $200,000 for deductions for a couple. In a place like Massachusetts, that's pretty low, especially given mortgage interest. But there's something really smart about this, and that's why Feldstein proposed it. He said, why fight with the charities, the mortgage people, each of these individual things? Just have a cap on the whole thing, and then no one can tell where it's exactly coming from. I think there will be some sort of cap, but I think it will be expressed as something like no more than 3% of your income or no more than 5% of your income, which will give a lot more leeway for high-income people. So those are the main things that are going to happen in individual tax. Most of it's going to stay the same. We'll have a lower top rate for individuals. We'll have these dependent care and earned income credits, and we'll have a lower investment, no investment surcharge, and we may or may not have some sort of cap on itemized deductions. Anyone want to ask a question about individuals? All clear?
What does that cost? What's the price tag on that?
The price tag on that isn't so bad. The price tag on that is, over 10 years, is a few $100 billion, because the low-income stuff doesn't cost that much. The consolidation itemized doesn't. And he's lowering the rate from 39 to 33 or 35. But if he capped deductions, that's worth a lot. So several $100 billion, no big deal. Now, it's a good question, Jim, because we'll see the others are very big deals. So the next one is the state and gift tax. So here's a question. Jim has promised to give a candy bar to anybody who can answer it. How many states out of the 50 states, other than Massachusetts, still have an estate tax? Does anyone know? Turns out the answer is 13. Even and the ones that have it, like New York, have conformed it to the federal. The federal estate tax is now got an exemption of $5.3 million per person, or $10.6 million per couple. We at Massachusetts are still at $1 million. Even New Jersey is doing away with its estate tax, and it already has an effect. Already people are going to Florida, they go anyway, but now we have lots of people going to New Hampshire. So this is a big issue for Massachusetts as to when all these entrepreneurs make all their money, do they then retire to New Hampshire or Florida, or do they stay here? And if we still have an estate tax and we become like one of only 12 states that have it, you could bet that people will find other places to go. Now, Republicans have generally called the estate tax the death tax, which means that they don't like it and they would very much like to repeal it. But here's another piece of esoterica. So just think about how well you're going to do on the next trivia question. There is something called step up in basis at death. And the estate tax exemption has always been tied to this. The step up in basis at death means that if you have your tech company stock, which you bought for $2 a share, and when you die, it's $100 a share, you can give it to your children. They can sell it for $100 and they pay no capital gains tax. Why? We've stepped up the basis from $2 to $100. That tax is still subject, that gain is still subject and the stock is still subject to estate tax, but in terms of capital gain tax, what step up in basis means is at death, automatically, everything you own appreciates to its current value at death, so you never pay a capital gains tax. Now, most Republican proposals say if we were to remove the death tax totally, we would bring back the situation where you would be taxed as a capital gain at what you own at death. Now that turns out to be a very complex thing. First of all, a lot of people don't even remember what they paid for stock 50 years ago. Second of all, a lot of people aren't that liquid. So they have this, but things like land they can't sell. So third of all, we have 52 Republican senators and 48 Democratic senators. So I think that really means that we can't do something so radical as eliminate the estate tax. Think about it this way. 52 of the most prima donna people you've ever met all are going to have to agree on this. They can only lose one, otherwise it doesn't pass. All of tax passes by the budget reconciliation procedures, which means all of tax in the Senate only requires 51%, 51 votes, not 60. But you still have to get those 51. And there are moderate Republicans who I think would not agree to this. On the other hand, I think it is pretty clear that we're going to increase the exemptions for estate tax. And you may think 5.3 million is plenty, but given house prices and other things, lots of entrepreneurs, I think we'll see that exemption go up. Wouldn't be surprised if the couple's exemption went up to 15 million or 20 million, and we'll keep step up in basis in death. The more people understand step up in basis in death, the more they'll decide that that's really important to keep, that they don't want to have to have their kids or their grandchildren sell everything at death. It's like a deemed tax. Otherwise, at death, then you're sort of deemed to have a sale and you're selling at a historic price. So it's a big capital gains. So if we just move up the estate tax by 5 million or 10 million, again, chimp change, 200-300 billion over 10 years. Now, to give you a sense of why I call it chimp change is, let's talk about domestic tax. So is there anyone in this room who is against reducing the corporate tax rate from 35 to 25%? Please raise your hand. Okay, we got one. It turns out that the cost over 10 years is 1.2 trillion. Is that enough for you? 1.2 trillion. So Donald Trump has proposed that we reduce the tax from 35 to 15%. So that would probably cost in the area of $3 trillion over 10 years. Now, really interesting, if you read his campaign, he has this little provision that says, and in order to finance this tremendous reduction, we are going to eliminate all corporate loopholes, all special interest preferences, except for the R&D credit. Now, to show you how little he understands about that statement, one of the preferences he would be eliminating is the special lower rate for manufacturing in the United States. If you manufacture in the United States, you pay a lower corporate rate than you do any other industry and any other place. So would he really agree to eliminate the special preference for manufacturing? No way, Jose. Of course he's willing to take away the incentive fee special treatment for incentive fees for hedge fund managers. We now tax that at capital gains rates, when I think there's a compelling argument to say that it should be taxed at ordinary income as compensation. But here's the rub, 18 billion over 10 years. It's nothing. Remember, we're talking about 1.2 trillion. So we're not even close. So I think the chances of his actually getting this rate down to 15% is essentially zero. And even if you look at it, traditionally, the Democrats have talked about bringing it down to 28%, and traditionally the Republicans have talked about bringing it down to 25%. Kevin Brady, who's now chairman of House Ways and Means, has taken over for Paul Ryan. He uses the concept of leapfrogging. This has no actual relevance to what he's talking about, but it sounds very good. He says, why only go down to 25%? Let's go down to 20%. We should leapfrog. Who are we leapfrogging? It's not clear, but we would get down to 20%. So I think that probably a realistic view is we will bring down the corporate tax rate to somewhere between 28 and 20%. And if I had to guess, I'd say 23 or 24%. And I didn't just take that out of the sky. That turns out to be the corporate tax rate that's paid in Germany. And the UK is actually down to 20%. So the US corporate tax rate at 35% is very high, and there is a consensus that it should come down, but the notion that it should come down to 15% is crazy. And I think a realistic thing is to bring it down to say 23%, which would cost 1.5 trillion over 10 years. And incentive fees, remember that thing for hedge funds, that's only 18 billion. So we got another, let's see, 1.3 trillion to make up. And of course, people in Boston would say, the oil and gas depletion allowance, we should just eliminate it. That's a corporate loophole. I can assure you in Texas, there's no one who views that as a corporate loophole. And similarly, we have a special exemption, no corporate taxes for credit unions. The banks hate that. You think we could pass that? You think we could start taxing all the credit unions in the United States? Wow. These are very strong lobbies, and these things aren't going to happen. I've been in many rooms where everyone is virtually shouting, we need to bring down the rate to 25 or leapfrog it to 20%. And then you say, who is willing to give up their special interest? Suddenly, silence falls upon the room. And basically, nobody wants to give up anything. Your loophole is my entitlement. That's the basic thing to remember. Now, Trump in the domestic area has, in addition to these proposals so far, which are within reason, has two totally outrageous proposals, which I hope are never passed. The first proposal is his treatment of business investment. Now, if you understand business investment, you make an investment and then you depreciate it over its useful life, so you deduct it. Software is usually deducted over 5 years, and other equipment may be deducted over 10 years or 15 years. And from time to time, we've had something called expensing. Expensing means you get to deduct today that new Xerox machine. But we've only applied it to very small businesses and like up to 50,000. Well, his proposal is that every business in the country, for all business investments, should have the chance to elect to expense all of their new investments. This alone would cost $1 trillion. And the whole concept of depreciation out the window. We no longer look at the useful life of things. We just say we want to promote investment, so therefore we'll do this. Hopefully this will be cut back and we'll go back to something like we've had in other times where we allow expensing for small businesses or up to 100,000 or for special startups. But do we really want to give IBM, say, $1 billion immediate expense for some plant that they build in Kansas? I don't understand why one would want to do that. So that's a pretty big and bad idea. But he has another idea which may actually be worse than his first one. And that is, we have these things called pass-throughs. Pass-throughs include partnerships, they include limited liability companies, and they include sub-S corporations. What we mean by pass-through is, as most of you know, you don't pay an entity tax. All of the income is allocated to the partners or the owners, and then they pay individual tax. Now, because of the very high corporate tax rate in the US, we now have a lot more pass-throughs than we do have corporations. And this is a very strong lobby. And Donald Trump, totally kowtowing to that lobby, has decided that even though the top individual rate is 33%, if you get business income from any type of pass-through, we're only going to charge you a rate of 15%. Now just think about that. Pass-throughs already get a great deal because they have no entity level tax, but we then tax them usually at the normal rates of individuals. So here we would change that and say, if you get money from a pass-through, then it's taxed at 15%. What would happen if this actually passed? Everybody, how many people we have here who are employers? A lot of people. So every employee you have will set up their own limited liability company and ask to have a contract between them and you in which they'll be paid. Because then that income that they pay will go through them, the service corporation, and be paid to them as pass-through income. So before, while they were being paid and had to have a tax rate of 33%, now, because they will be in a pass-through, then they will only pay 15%. So what's the estimate on this? The estimate is roughly $1 trillion without cheating. Cheating adds another 500 billion. And you would really have to have a very serious enforcement effort in order to stop that. So let me pause here and say, anybody have questions? Yes.
Wouldn't the contractor laws prohibit what you just explained? I mean, Massachusetts, you can't, it's impossible to have contractors.
Well, you can always have an independent contractor. So your employees can easily be converted into individual contractors, and you as an employer would pay the limited liability company of which they would be the sole owner, and the sole owner would then distribute 100% of the income to the employee. And
that Massachusetts list of what it really attributes to a contract.
well, all you have to do, that list is one of the most litigated lists in the country. And I can assure you that we will press this particular approach to the limit. For instance, your employee will no longer, it'll be good for you to say, you won't have a regular office. You might have to work from home. You'll have to supply your own broom. We won't give you a broom. But to go from 33% to 15%, people will do a lot. So I think it is a sort of cardinal rule of tax law that whenever you create a loophole, it is exploited to its maximum. And this one is like just hanging out there. I mean, with an 18% difference in rate, right? I mean, I would say it would be a tax lawyer and tax accountant's field day. Other questions? Yes, Jim.
I've heard so much about, this is about enriching Donald J. Trump and his family. Would that pass-through law have enormous implications for real estate developers?
Oh, it would be tremendous for real estate developers because real estate developers only operate through pass-throughs. They all use either limited liability companies or these things. So they would definitely get a lower rate. So as I said, this one combines huge deficits with very poor design plus personal bias. Outside of that, it's a great provision. So just to try to be more even-handed, I would say that Trump's proposals for foreign tax are actually quite reasonable and actually much better than what we've seen from the Republican Party in the past. So Today we have literally the worst system that you could devise for the taxation of foreign profits of US multinationals. Like if Jim and I sat down and say, let's see if we could design the worst system, we would come up with our present system. Our present system is, in theory, Google and Amazon, anybody who sells abroad, whatever profits they make abroad, they're subject to a 35% tax from the US, except they don't have to pay that tax unless they actually bring that money back to the United States. So guess what? They don't bring it back. How much they don't bring it back? The current estimates are $2 to $3 trillion is sitting in foreign places, often branches, foreign branches of US banks, and just sitting there, and they're waiting. What are they waiting for? They're waiting for another tax holiday like George W. Bush gave them in 2004. But there is now a strong consensus we should never have another tax holiday alone. Because if you have a tax holiday every 10 years, then we will never have corporate tax reform because they'll just keep waiting. So Trump actually has a sensible proposal. He says, let's divide this between the past profits that are already there and future profits. And he says, as to past profits, we're basically going to impose a one-time tax of around 10%. There are a lot of different technicalities of it. And it will be a lower rate if you've already taken those foreign profits and put them into the ground overseas. And that's what happens. Because if you're a foreign company like Amazon, your incentive to build facilities outside the United States is huge. Because if you bring it back, you're taxed at 35%. You go to Singapore, 5%. Go to Bahamas, 0%. So it's amazing how much business is done in the Bahamas these days. Incredible. And he says, so 4% on fixed assets and 10% on liquid assets. And once you pay that money, you can bring it back to the United States. And that should raise something in the area of 150 to 200 billion as a one-time tax. And he says, let's devote it to infrastructure, that 150, 200 billion. So that's a pretty good idea. It's actually not that different than what Hillary Clinton would have done. Again, assuming that we know what we're talking about when we say infrastructure, which we don't, but it sounds very good. Everyone likes infrastructure. For some people, it means bridges. For other people, it means private-public partnerships. For other people, it means harbors. It's just something that everyone loves. The industry gets a chance to make a lot of money. The construction unions construct everything. Everyone's happy. And probably some government officials take a few side payments, so really everybody is happy. So that's his proposal going backwards. And going forwards, he had the strength and the courage to say, no more deferral. No more of this, if you don't bring it back to the US, you don't pay taxes. He said, I'm now going to say that from now on, whenever you make profits as a multinational outside the US, you're going to pay a 15% tax in the year that you make it. Now, you can argue that 15% is too low, but remember, UK is at 20%, and 15%, of course, is just a negotiating number. But the idea of cutting out deferral and instead having some rate that's a little lower than our corporate tax rate for domestic is a pretty good idea. And that means implicitly, instead of parking all your money in the Caymans or Bahamas and paying 0%, you're now going to pay 15%, maybe 20%. And that would actually raise a lot of money. Why do I think that's good? There are two other Republican proposals. One is in the category of really bad idea, and that is something called territoriality. Territoriality, people will tell you every country has territoriality. Take my word for it, they don't. They have modified territoriality. what does territoriality mean? Territoriality means you only get taxed in the country where you produce the profits. Now, if we did that, there would be such a competition between Ireland, Poland, Kazakhstan, Singapore, to bring every single facility, every single research thing out of Boston into these places. And they would all offer 5% tax, 8% tax, 10% tax. So if you really wanted to strip the US of most research and manufacturing facilities, you would adopt territoriality. Now, Paul Ryan, who's a very smart guy, says, I don't like territoriality, and he's come up with a new idea called foreign sales destination tax. What does this mean? This means if you sell anything in the US, you pay the US corporate tax, but if you sell something, not manufacture it, if you actually sell it in Poland or in the Bahamas or in Russia or in Japan, you pay no US tax. And that's actually better because it's easy to locate plants in places like Poland and the Bahamas. It's not so easy to sell that much in Poland and the Bahamas because there aren't that many people to sell to. So there's a limit. So foreign sales destination is a better idea than territorial, but not as good as Trump's idea. So really, when you think about it, it's easy to say, and there's a lot of evidence that Trump doesn't know what the hell he's talking about. It's easy to say that he probably doesn't even know what's in his tax plan. I wouldn't try to bet against that one. On the other hand, whoever put it together, the 2.0 version, clearly knew something about tax. Now, you can debate how far you're going to bring down the individual rate. It's not a crazy idea. He's done something for low-income people, so they'll like that. His proposal for foreign tax makes a lot of sense. Unfortunately, his domestic corporate tax proposal is really terrible. It tries to bring down the rate so far that it's unrealistic. It gives special deals to pass-throughs who already have special deals, and furthermore, it allows people to expense everything without depreciation. But as I said, in the end, he can't get all that through, especially the domestic corporate tax, because there is a limit that the Tea Party will tolerate in terms of how far it's willing to raise the debt ceiling. Remember again, March, automatically the suspension of the debt ceiling comes off, and by the summer we will have violated. We will actually have violated the debt ceiling as of March, like 2 seconds after the suspension is over, but the Treasury has a number of games that it plays that therefore they're not technically in violation. So we will need a vote of Tea Party Republicans as well as some Democrats to raise the debt ceiling in the summer. So that is really actually more important or as important as having to get 51 of 52 Republican senators on your side. So, of course, there'll be things that some of us wouldn't like, and there'll be other things that we think should happen, but it's the combination of 52 Republican senators plus raising the debt ceiling on the House that's going to keep him constrained. So I personally think we will have reform of foreign profits. Exactly what form it will take, I'm not sure. I don't think we're going to bring down the domestic rate any further than 23, 25%, but that'd be a step in the right direction. And we'll see what happens in terms of revenue raising. Remember, he's also promised not to cut back benefits for Medicare or for Social Security. So the two big pots of money that he could use to offset the deficits that are going to be created by the tax cuts and these infrastructure projects, he doesn't have that. So what he'll probably do is have a tax cutting program that will cost maybe $2 trillion, $3 trillion over 10 years. And he'll have infrastructure projects which he'll try to shove off balance sheet as much as he can by having government guarantees, public-private partnerships, anything that doesn't have to go toward the national debt. And if he stays in the $2 trillion over 10 years, he can probably get a vote in the House that will improve the increase in the debt ceiling, because it wouldn't have to be the whole $2 trillion at once. And he probably can get 52 Republican senators. But very likely, a few of those senators, Republican senators, are going to fall off. So he's going to need a few Democratic senators. And very likely in the House, he's going to need a few Democratic votes, because some of those Tea Party guys don't want to even raise the debt ceiling by 2 cents. So that's the dynamic that's involved. And the last thing is, remember, in 2 years, the Democrats have a chance to change that 52 to 48 to 52 to 48 the other way. It was pretty close this time. So he's got a 2-year window, really, to do the things he wants to do. And he clearly wants to change Obamacare. He doesn't know how to do that. That's a big deal. He wants to renegotiate most of our trade agreements. He doesn't know how to do that. In fact, it's unclear whether he could do that, whether he should do that. So taxes are something that he really wants to do, and I think he'll do it. But he'll do it in a lot more moderation than this plan, because while this plan has some good aspects, it also has some crazy aspects. Let me stop there and I'll take a few questions. Yes?
Can you tell me anything about how this is going to affect my retirement funds at some point when I go to extract from my retirement funds?
Well, I don't think there are 2 aspects of retirement. One is Social Security. And we know that Social Security is going to go bankrupt in about 2032. But people often think that means 0. It doesn't. It means we'll have across the board 25% cuts. So for younger people in the room, they'll probably get 25% less than their schedule unless Congress does something to reform it. My sense is Congress will probably do something to reform Social Security about 2031. We've been talking about this for years, but why take all the grief now in 2016 for something that's not going to happen until 2032, right? So usually when the crisis is right at the door, you'll do something. Now, in terms of the private retirement, remember in your 401k, you're paying no tax when you put the money in. So you're taxed fully on the contribution and the investment earnings when it comes out. So how much worse can it get? It's pretty much that. The real kicker is the Roth IRA. And a lot of people say, oh, this is a great thing. You put in after-tax money to a Roth IRA, or you convert from a 401k and pay the conversion tax, and then you're not supposed to pay tax for the rest of your life, except if Congress decides that you should pay tax. And that is the kicker. And if I had to guess, sometime down the road, when we find we don't have enough money, Medicare, Social Security, we just might have a rule that says if your Roth IRA has more than $200,000 in it, maybe you got to pay tax. And that's, I think, the biggest risk in the retirement side. Yes?
Sorry to ask a really basic question, but you've talked a lot about good tax policy and bad tax policy. Can you define what's good and bad a little?
Yeah, there are a lot of different ways to define good and bad tax policy. One is a distributional aspect, and one of the things that I think is good about Trump's individual taxes is that he's got some things for the lower and middle class as well as for the rich, though his system is very tilted toward the higher earners, especially because most owners of pass-throughs are higher earners. So on distribution, he doesn't get a D, he surely doesn't get an A. A second thing is, if you have a system that can be gamed easily, that's a bad system. And his system for pass-throughs is like, you know, it's a tax accountant's dream, so we really don't want to fulfill their dreams. A third thing is to do with whether or not we get some economic growth out of this. as I said, the foreign tax system is crazy. We're collecting no revenue from this 2 or 3 trillion, but it can't be used in the US to build facilities, to buy technology. It can't even be used for dividends to be paying to US shareholders. Do you realize that Apple has 150 billion overseas? And when it wants to pay a dividend, it goes to the bank and borrows to pay dividends, and it can't use that 150 to collateralize it either. So that's what I call a really badly designed system from the point of economic growth. So try to have reasonable distribution, try to have a system that's enforceable without a lot of gaming, and third of all, try to do something that has a positive effect on economic growth. Those are 3 criteria. There are others, but those are 3 good starters.
We have time for one last question over here.
During the election, no one really wanted to touch the concept of actually closing the deficit.
Well, you're right to say I didn't hear a lot of discussion about the deficit. No one talked about it. That's because Congress had secretly decided to suspend the debt ceiling. How many people in this room knew that? No one. I mean, it's like, yeah, that's why they didn't discuss it. Also, remember, both candidates said they're not going to touch Social Security and not touch Medicare. In fact, they tried to fight as to who should expand those the more. And so those are the 2 big gorillas in the room. Once you take them off the table, it's really hard to say, well, how exactly are you going to squeeze that deficit down if you're not going to touch Social Security and Medicare? We've actually squeezed the defense budget quite a bit, and you then get into the discretionary budget, which just isn't that big. So for people like me, it's unfortunate that no one would talk about deficit reduction. We're in a bit of a hiatus here now because Medicare and Social Security haven't quite kicked in yet, and because we have such low interest rates. But we know that by about 2022, 2025, if rates go where we think they're going to be, we're going to be in trouble again. In trouble meaning that I think we'll be up to, say, our debt will equal over 80% of our GDP. And that's not a good place to be.
And my question really was around whether or not, is there anyone, either at the congressional level or in the Senate, talking about methods in which we can reduce that deficit?
Well,
Do you see any of that happening?
there used to be people who talked about deficit reduction. They're no longer in Congress. Anyone who was deemed to be reasonable or moderate has been driven out. Now you're either someone who wants to increase spending a lot or someone who wants to do major tax cuts, but this sort of really hard work of seeing what you would do intelligently to reform Social Security. I mean, we, for instance, know that Social Security is going, a good part of it, to people who are quite wealthy, have quite good 401k plans. We haven't integrated that concept. So there are a lot of sensible things that could be done, but basically, politically, they're like hand grenades. And so if you want to stay in office, you don't talk about them. And this used to be thought of as more democratic issue, but if you read the polls about people who voted for Donald Trump in places like West Virginia, one of the reasons they said it is he's not going to touch Social Security or Medicare. So that's why I think that it will take a few years. The deficit this year is going to be about 560 billion, which is within reason. It will grow over time, and when it gets big and starts to explode, then people will start talking about it. I really doubt whether they're going to talk about it much before then. It's a sad thing. There's a woman named Maya McGinnis who's head of something called the Committee to Control the Federal Deficit. She leads a very lonely life these days. But she's got a good website, and she really has a lot of good ideas, and she has a group of people that support her. None of them happen to be running for office or holding elected office. Thanks very much.